As we are all aware, 2020 was a consequential year for all of us. What begun as one of the strongest U.S. economies in history quickly turned negative towards the end of the quarter as the reality of COVID-19 took hold. Unlike the previous economic collapse of 2008 and 2010, the Federal Reserve learned that massive early intervention was needed to establish an orderly market to buy and sell fixed income products in the trading universe. As the slide shows, the amount injected into the system was far and above what was done during the financial crisis. In fact, the 3.25 trillion was more than 2.5 times the 1.4 trillion done in 2008 and 2010. To illustrate the magnitude of the damage done to even the highest grade corporate bond market, slide 2 shows how bad liquidity was during the early stages of the pandemic. We can see that 2020 began with a sharp rise in performance and fell off in March. Similar to 2008, 2010, the fixed income market froze up as investors had a flight to quality in both cash and U.S. Treasuries. Then, after the previously mentioned Fed intervention, they were able to reestablish an orderly arena for most bonds across the credit market. Again, the Fed saved the day. Due to the aforementioned flight to quality, the yield curve shifted dramatically downward from what was already a depressed yield curve. The short end finished the year hovering around 0% when the longer end could not break 1%. Can you imagine lending someone money for 30 years and getting less than 1% on your 3-decade investment? Personally, I can't, but clearly it is happening. Although there is a great deal of lending, such as banks and the government, and the individuals to refinance debt, the savers of the world were left with little return for their commitments. As the next illustration shows, although there has been an enormous amount of money pumped into the system, much of it is not being passed around at this point. This shows a couple of points. First, many individuals as well as corporations are sitting on cash in fear of another shoe to drop. But it also shows that with vaccines right around the corner, we can see a larger increase of money exchanging hands in 2021. Of course, this is positive news. However, there is a caveat with it. There's a possibility of inflation. Given the lack of inflation in the last decade, this may be a welcome sign to bring the yield curve back to a reasonable level. It will be an interesting battle between the Fed, who has promised to keep rates low, and the market, who will be demanding higher rates to accommodate the perceived inflation of 2021.